Hey everyone, welcome to The Explainer. Let's just jump right in today because we are unpacking what is literally the ultimate financial cheat code. Look, while amateurs are out there sweating over market crashes and obsessing over the latest financial news, the wealthiest investors, they use a surprisingly boring strategy that wins almost every single time. It doesn't require a crystal ball, and you definitely don't need to be glued to Jim Cramer all day. It's called dollar cost averaging. Today, we're going completely in-depth on why this one specific approach is statistically far more successful than trying to be some stock market genius, how it actually acts as a shield during a market crash, and exactly how much you should be fueling it with every month to hit your goals.
So I've got to ask, and I want you to be totally honest with yourself here. Are you trying to time the market? I mean, this is the most common and absolutely the most stressful trap that investors fall into. We try to guess exactly when the market is at its absolute rock bottom lowest point to buy in, and exactly when it's at its absolute highest peak to sell. And sure, it sounds great in theory, right? Buy low, sell high. But in reality, trying to perfectly predict those chaotic, wild market swings is a complete psychological minefield. And it's exactly why most people fail.
Because think about it, market timing traps us in two massive psychological pitfalls. On one side, you have people waiting for a dip that just never comes. They sit on a pile of cash, watching the market steadily climb, constantly telling themselves, oh, I'll buy in when it crashes. But the crash doesn't come for years, and they miss out on all that massive compounding growth. Then, on the complete flip side, you have people buying at the absolute peak because of FOMO, the fear of missing out. They see everyone else making money, they panic buy right before correction, and then literally watch their portfolio instantly shrink. Both of these approaches, they're driven entirely by raw emotion, literally the complete opposite of a reliable strategy.
Okay, so what's the fix? Well, it's dollar cost averaging, or DCA for short. Now, it is incredibly simple, but do not let the simplicity fool you into thinking it isn't wildly powerful. DCA basically means you invest a fixed amount of money at regular intervals, like, say, every single payday, no matter what the price of the stock or index fund happens to be that day. Markets up, you invest your fixed amount. Markets down, you invest that same amount. Markets just moving sideways, you invest. You are completely removing the guesswork and totally removing the need to predict the future.
And when you stick to buying monthly, this fascinating dynamic takes over. This really breaks down the core mechanics of why DCA is so ridiculously successful compared to just, throwing all your cash in at once. When prices are high, your fixed amount of money naturally buys fewer shares. I mean, that makes sense, right? Things are expensive. But here is the magic trick. When the market crashes, your money acts exactly like a giant vacuum. Because you're still investing that same fixed amount, your money automatically buys significantly more shares while they're on sale.
Actually, let's look at the math for a second to really see this vacuum effect in action. Say in step 1, you make your regular $100 contribution. The shares cost $20 each, so your $100 buys you 5 shares. Easy enough. But then, step 2 happens. The market drops. Everyone's panicking. The share price falls to $10. Now, because you are using dollar cost averaging, you don't panic. Your automated $100 just goes to work. And because the price is now only $10, that same exact $100 bill suddenly buys you 10 shares. You are mathematically forced to buy way more when things are cheap and less when things are expensive. Boom. You've essentially turned Wall Street's panic into your own personal Black Friday sale.
So, 5 reasons DCA wins. 1. Lowers average cost. 2. Kills that fear of regret. 3. Emotional immunity. 4. Simplifies life. And 5. Compound interest thrives. Let's dig into these. First up, it naturally lowers your average cost over time. This directly ties right back to the math we just went through. Because your fixed dollar amount automatically buys way more shares when prices drop low, you are dragging down the average price you paid for all your shares combined. Your overall break-even point actually drops. You don't even need the market to hit an all-time high just to make a profit, because you've been gobbling up cheap shares all the way down during the dips.
Next, and this is a big one, it gives you emotional immunity and absolutely kills the fear of regret. Look, we've all been afraid to invest because of the what-ifs. What if the market tanks tomorrow and I lose everything? With DCA, you flip that psychology completely upside down. If the market drops tomorrow, you're actually thrilled. Why? Because you know your next automatic contribution is going to go so much further and buy those shares at a massive discount. You can officially delete those stressful stock checking apps off your phone and ignore all the talking heads on TV. You literally become a disciplined, emotionless investing machine.
Which brings us to perhaps the most important rule in all of investing. Time in the market beats timing the market 99% of the time. Dollar cost averaging practically guarantees that you are always in the market. It simplifies your life completely. Instead of spending hours doing research, stressing, trying to guess the perfect moment, you just DCA into a broad index fund, spend maybe 5 minutes setting it up once, and then you are done. And by constantly being in the market, you're making absolutely sure that compound interest has the time and the fuel it needs to really thrive and multiply your wealth. Okay, so we know the method. Now let's talk about the fuel for your machine, your budget. Like, how much should you actually be automating into this system? Well, financial experts generally agree on a golden number, the 15% rule. Meaning, you want to aim to invest 15% of your gross income straight into your DCA strategy.
Let's make that math super real for a second. If you're pulling in a gross income of $60,000 a year, following the 15% rule means you are putting $750 every single month into your DCA machine. That $750 just goes to work for you automatically, every month, buying fewer shares when the market is hot and scooping up tons of shares when the market takes a hit. It is completely 100% hands-off wealth generation.
Now here's some of you out there. Setting aside 15% right off the bat, that can feel like way too much, especially depending on your current situation. And hey, that is perfectly okay. If the 15% rule feels just a bit too intimidating to start out with, experts offer a really fantastic alternative, which is the 50-30-20 rule. This just means you allocate 50% of your income strictly for your needs, so housing, groceries, the basics. 30% goes to your wants, the fun stuff, going out, entertainment, and a solid 20% is locked in for your financial future, which covers your dollar-cost averaging investments, along with things like paying down debt.
But listen to me, here is the absolute most reassuring and vital thing you need to take away from this explainer today. The most important part of DCA is not the specific dollar amount you start with, it's the consistency. Consistency is way greater than the dollar amount. If you look at your budget today and realize you can only afford $50 a month right now, start there. Just do not wait. That habit of showing up every single month, rain or shine, up market or down market, that is what truly builds a $1 million portfolio over time. Start small and just let the machine do the heavy lifting for you.
All right, moving into the safety first caveat, protecting your machine. Because before we launch your DCA strategy, we need to make a serious pivot here and talk about protection. You must clear out high-interest debt, like credit cards, before going all in on investing. I mean, it is just basic math, right? There is absolutely zero point in trying to earn an 8% return in the stock market if you are simultaneously paying 22% in interest to a bank on your credit card balance. You are literally bleeding money faster than you can grow it. The math simply does not work in your favor until that high-interest debt is totally cleared out. And right alongside clearing out that high-interest debt, the other half of this safety caveat is keeping a small emergency fund. You just need some cash reserves sitting safely in a basic bank account. Why? Because, well, life happens. Cars break down. Medical bills pop up out of nowhere. And if you have a personal financial crisis, you want to use your emergency fund to handle it so that you never, ever have to hit pause on your DCA machine. You want that automated investment to just keep chugging along without interruption, completely insulated from your day-to-day emergencies. So to summarize everything we've looked at today, dollar cost averaging really is the absolute closest thing we have to a genuine cheat code in finance. By simply automating a set amount of money at regular intervals, you entirely strip the crippling stress and raw emotion right out of investing. You don't have to predict the future, you literally just set it, forget it, and let the strategy permanently put the math on your side, automatically buying up deals during every single market crash.
So I want to leave you with this to think about, and I really do want to hear from you guys down below. Are you currently using DCA to build your wealth, or are you still sitting on the sidelines waiting for that imaginary right time to buy into the market? Let me know in the comments. And hey, if this explainer helped clear things up for you, hit that subscribe button so we can keep building your financial IQ together. I'm your host, and I will see you on the next explainer.